Welcome back to Halftime Report. Now, CLSA's recent report indicates that the second quarter of the financial year saw the biggest earnings misses in recent memory. Now, adding to that is higher inflation in some commodities and deflation in others also caused havoc. Now, to discuss this and more, we have Aditya Soman, the Senior Research Analyst at CLSA from the 27th CLSA India Forum. Aditya, good afternoon. Thank you so much for joining in. What do you make of this second quarter performance, right? Particularly from the consumption-oriented theme, a lot of these companies talking about pressures that have come in when it comes to volume growth as well. What do you make of this, and do you see an improvement coming in the second half of the year?
Hi, good afternoon, and thanks for having me on. So three things that I can point out from the quarter. So one, I think it's been universally called out that rural growth outpaced urban growth in the quarter. Although both were sort of slower than past trends. Now, the point I'll make here, though, is if you disaggregate urban growth, look at sort of metro cities and non-metro cities, it's very clear that the metro cities is where we are seeing a much sharper deceleration. In fact, non-metro urban India continues to grow faster than rural India. And to my mind, there are several reasons why metro cities in urban India have grown slower. One, I think we're just seeing a lot of new age companies use new platforms to distribute, platforms like quick commerce, modern retail, e-commerce, which have been growing much faster. And a lot of this data is not being captured in traditional sort of panels like Nielsen or Kantar. Secondly, we are seeing larger companies actually lose market share to smaller or mid-sized companies. Again, part of it is just distribution realignment, where the larger companies used to have a huge advantage in distribution, particularly in sort of smaller towns and rural India. But in urban, large city India, we are starting to see competition come in, which uses the platform provided by quick commerce or modern retail to expand faster. And the third is there is a little bit of a slowdown in point of sale consumption, whether it was sort of unseasonal rainfall or just city specific issues that led to slower consumption. So that's the overall view, but happy to dig into more detail.
Let's get into more details then, Aditya. A bunch of companies, I don't know whether you track Honasa yet or not. So I'd like your views on that, if you at all do track that. And the second view that I'd like is your call on DMart. You have an outperform rating on DMart. So at a time when a lot of people are, looking at DMart as a sell or an underweight, largely because of the quick commerce related issues and them not growing so fast, I want you to explain your outperform call on DMart, and if at all you can comment on Honasa.
Yeah, so we don't cover Honasa at this point, but what I'll say in general is we are seeing this transition. I think it was mentioned previously that there's a transition towards more active ingredient-based plays, and that's something that's clear to see. There's also a disruption in the channel in general for a lot of FMCG companies, particularly in large cities, and that's impacting a lot of companies. So I'll leave it there, but I don't want to sort of specifically, we don't cover Honasa. On DMart, again, I mean, I cannot make company-specific comments, but the point I'll make is, yes, quick commerce is here to stay. It will be very disruptive as a channel. That being said, I think we are seeing traditional retail companies respond with a shift to private label, respond with more aggressive pricing, and that's something that you can see on the shelves today as well. So we clearly believe that there's a space for quick commerce where it offers convenience, it offers ease of use. However, when you think of large carts, large SKUs, I think there's still a place for traditional modern retail to exist and even thrive. The important point here is from a cost perspective, a lot of these traditional players still have an upper edge on cost. And over time, we might see this get disrupted. But for now, we are seeing that the cost advantage that the traditional players has persists.
What about paints, Aditya? There has been so much chatter going on about the sector as a whole, isn't it? The market leader is saying that there are challenges when it comes to demand. The newest entrant is saying that, yes, there is a slowdown, but it is not as much as some of the other players are making it out to be. What is the sense that you are picking up on the ground, and is this competitive intensity likely to cause a valuation reset for a lot of these companies, specifically for the leader?
Absolutely. So look, our view is that in markets where distribution was your sole competitive advantage, I think that's starting to get disrupted very fast, whether it's paints, whether it's FMCG. We are seeing this trend play out very clearly. In paints, our concerns are very specific, that we've got a few new entrants. There's obviously one very large new entrant, and there's several that have been around for a few quarters or years. And the environment is likely to get murkier before it gets better, in a sense that when you have new entrants making such large capital outlays, it's unlikely that they're just going to fade away without making any sort of impact on the market. And we're starting to see that, whether it's in offering higher rebates for dealers. I think that was something that was called out in the recent quarter. Whether it's seeking out those same dealers in different formats, whether it's improving their ROI through better working capital. I think all these trends will play out over the next few quarters. Now, the concern is that some companies made disproportionate ROI, and that ROI might get disrupted, at least in the short term. Now, whether this plays out over a longer term, whether the sort of leaders stay leaders over a 5-year view, our view still remains that the market leaders will stay the same over a long time. But in the next couple of years, while some of the newer entrants make their foothold, that there'll be significant disruption, particularly on ROI and margins. So that's where we see the biggest concern, not so much on sales.
All right, Aditya, final question before we let you go, and this won't be, stock specific, but there are a couple of interesting nuggets that we get from your report. The first one is that quick commerce incremental GOV has been a lot higher than incremental staple spending. That's telling you about an underlying shift in consumer behavior itself. And Zomato's incremental food delivery GOV itself was more than all the major QSR chains' revenue. So that again is telling you that, there is a significant shift in consumer preferences and spending. So the question that I'm asking you is that, just the way there was a naturals wave and the legacy companies did not benefit from that, do you think there are underlying mega trends with the current listed entities may not be able to benefit from, just because they're perhaps slower on the ball, or the others have actually got the consumer sentiment right?
Yeah, no, great question. So let me answer sort of it in a little more detail. So firstly, with food delivery and QSRs, I think this is a trend we've seen now for several quarters, where the incremental sales for food delivery or the GOV of food delivery for Zomato and some of the other players has been actually much higher than the incremental sales for the QSR companies. Now, this trend is likely to stay given that competition in smaller towns enabled by the aggregators continues to improve. So now we're not saying the listed companies cannot adjust. I think we've seen that even with naturals, as you mentioned, where eventually the listed companies readjusted their play and made the adjustment necessary to compete better. But that takes time. It takes companies to acknowledge the challenges that lie ahead, and once they do that, they typically will adjust. Our call is that in the here and now, while this adjustment takes place, there is a meaningful disruption. And it's the same with FMCG, right? I mean, even 3 quarters ago, quick commerce was seen as largely a fad. Now, more or less, people agree that it's a business that's picking up. Consumers want it. There's a clear change in mindset from a consumption perspective. And so we'll see the FMCG companies adapt to this change over time. Now, what implications that has on sales growth, what implications that has on margins and returns, I think that's where the questions lie. Our view is that the best companies will adapt to the challenge, will adapt to having more products suited to be sold on quick commerce, and eventually differentiate between the channels to provide everything for every channel. That being said, in the here and now, there will be disruption on profitability and ROI, and maybe some of them will also be forced to make acquisitions, which again could sort of bring into question some of the ROIs that they deliver. So that's the view for now. The main point being that you'll see a lot of newcomers leverage the platforms provided by quick commerce or the food delivery platforms to compete with the traditional companies which have been so dominant for so long.
All right, Aditya, we leave it at that. Thank you so much for sparing time and joining in. Wish you good luck for the conference ahead as well. Now, time for a short break. More on the markets and stock-specific action on the other side. We also give you an F&O wrap at midday. Stay tuned.